Welcome to Momentum Monday. Today is September 4th, 2022. Howard,
Yes, sir.
have you been doing any trading or you're just enjoying the summer?
I have been training, not trading. Take off my glasses. You know what? I gotta wear them. I have like 9 pair of glasses now for different lengths away from my computer. I am headed on a vicious, fun adventure. I've been training for like 6 months. So just to survive, work and fun. So I would say, I don't know, training is not as like I'm kind of looking forward to the end of the training, which I'm in right now. But no trade, you know me, I've been talking about it here with you. I'm overmatched, so I'm just high cash. It's funny because I'm in Toronto, which the market, the markets here have been unaffected by any kind of real estate interest. And finally, even the Toronto real estate market is soft, which is, it's been a bull market for, I don't know, 20 years here, 30 years in real estate. So
But
it's the
that's a
first
good
time.
thing, right? Because in the past 2 years, real estate went up 40%. So it's a good thing if we see it soften up a little.
Yeah. Yeah. I mean, I don't know, good thing, bad thing. It's not fun to see prices go down. Like people, like, you and I can survive, but most people just have not seen this. I mean, most people onboarded from 2020, right? Like the young generation has not seen this, and the older generation has not seen, again, I hate saying the word inflation, but it's inflation, right? Like I don't feel as much as the average person, but there's this massive amount of inflation all over the place, right? Like depends on what business you're in. But you combine that with high, but yet the rates, the difference between the Fed rates and the inflation rate is still so huge. And in Europe, it's huge. So it's really a dollar and interest rate. All I'm focused on and watching is the US dollar and interest rates. And because I'm in my head, it's like be 50 to 70% cash with my growth investing, based on where this dollar is and where interest rates are. Like I need both to reverse course. And you'll see it in
You're a macro guy.
I'm not a macro guy, but there's a point that the macro is screaming. I'm not a macro guy on my day job, which is investing in startups. Who cares? If you're focused on getting your first 10 customers, what's the macro matter? But the macro does matter in many ways, Ivan. So let me just walk you through this. The macro matters. Let's pull back to the US dollar. Okay. How many crypto people and everybody have told you like the dollar is going to crash over the last 5, 6 years, right? It's like Bitcoin this and crypto that. And look what the dollar's done. The so and then interest rates. So the dollar should stay strong as long as the Fed's raising rates, because we're so far ahead of where the Europe is in terms of their reaction to this inflation. Plus, we have energy, they don't. So we are the strongest house in what is a global shitty neighborhood right now, right? Like, it's great to be an American citizen at this point, if you're middle class and above. And if you're not rich in Europe, it's tough. If you're not rich anywhere else, you don't have mobility. So US dollar remains strong. Interest rates, on the other hand, are just going to crush, the spirit of speculators, because it creates competition for dollars for your investments, right? If interest rates, you can get risk-free T-bill rates at 2-year rates at 4%, 3.5%. That's different than 0%, which we were at 6 months to a year ago. So that's just pressure for the extra investment dollar. Where does that come out of? Growth. Okay, so if we look at the QQQ, which is where I hunt and fish, what's the point of hunting and fishing when I believe that rates drive this? So I'm just watching rates to see when rates, again, I don't have to catch bottoms. So I'm looking for relative strength. long story short, Ivan. So now you tell me I mean, how do you see anything good here, medium, short term, long term, like that chart right there?
I mean, what I'm seeing is mostly bearish price action, just from various angle. It's just bearish. Like if we zoom in to a daily perspective, you can see we have an increase in distribution days. Here, look at that big red volume bars. We see that typical bearish market price action where we have like a slight gap up, green open, and then a weak close. Multiple days in the past 3 weeks. We saw all major indices kind of, they had a couple months summer rally. They rallied to their declining 200-day, and then they found resistance and then been pulling back since then, both small caps and large caps. The Qs
It's so heavy.
didn't
I mean,
even
technically that's so heavy, Ivan.
yeah. And lately, I also noticed that correlations have gone up a lot. Like stocks have started to move together again, which is basically one of the signatures of corrections. And market sentiment is shifting back to bearish. Like just a few weeks ago, it was normal to see companies miss earnings estimates or guide lower, and they would gap down, but they would quickly recover and even rally. And we saw so many examples this earnings quarter, at least short term, they recovered. But in the past week or so, I'm noticing the opposite, that both positive and negative earnings surprises are starting to get sold, which to me, this is the shortcut to understanding current market sentiment, is how the market is reacting to earnings, to both good and bad reports. And lately it's been selling them, all of them, indiscriminately, which just comes to show that the risk appetite is quickly disappearing, and people are raising cash probably, or maybe buying T-bills just like you did. So this is what I'm seeing mostly. It's just bearish price action. Obviously, there's still some leaders as of right now that are kind of holding well, and maybe they'll build new bases. As it's possible that as the indices potentially pull back and test their summer lows, it's possible that we see something like First Solar or ENPH. They can just build a new base above their 50-day while the indices are having issues, and potentially they could be new leaders out of this correction. And we've talked about the seasonality of the midterm elections, how stocks tend to be weak right before the midterm election, which I believe are like early November, and they tend to be very strong after. So if we see some type of repetition of that, maybe we retest the lows in the next month and a half, and then we see stronger price action towards the end of the year.
Yeah, I agree. Let me walk you. I don't want to talk about individual stocks, but I want to talk about how I see some scrubs. Let's take a look at Apple first.
Okay.
And you can see the relative. Ooh, that does not. I'm kind of back bearish on Apple technically. Give me a weekly, Ivan.
Here you go.
Yeah. So look at the relative strength of Apple, the largest company in the world, right? Which, people are thrilled. Everybody owns it. It's the biggest probably position I have, which is kind of like a cop out at this point. But you have to. Here's why. Apple has single-handedly, I think one of the greatest moves Apple made is two moves it hasn't made or announced. They never went out and bought a social media account. Like, I've been really thinking this through, and like how Tim Cook, lack of doing things has been genius. People complain about like that. What have they done lately, right? Like, lots of truth to that, maybe, other than the watch and the fact that the iPhone still leading. Maybe that's all he had to do. But the two biggest things he hasn't done is, one, we all thought he should buy a social network. Well, he has one in his iMessage. And the genius was, and this is evil at many levels, they never bought like a Facebook, a TikTok, a Snapchat, or a Twitter, and everybody screamed for them to do that. But what they did was, they avoided doing it and they killed them instead with their iOS. So let's just pull up Snap and Shopify to give you two examples of markets that Apple destroyed. If we look at Snap, their mistake was not diversifying, much like Peloton or any great company that has a high currency stock price. But Snap was not big enough to withstand the changes to the Apple advertising privacy rules. Like 90 to 95% of people opted out of those Facebook, Snapchat, Twitter ads. Facebook is a much bigger company. You can see what it did to Snap. And then we look at Shopify. And then we can look at Facebook too, they've made the massive blunder of what Shopify didn't see, or what Toby didn't see, was that they were so dependent on small DTC brands that were growing on Facebook, that indirectly by Facebook getting killed, all these small DTC companies or one or two person shops that would source something on Alibaba, put it up on a Shopify store, and then go to Facebook once they had and figured out how to buy thousands of users, that's over, because everybody opted out of Facebook. So you have all these small DTC companies that have no teams capable of doing true marketing and growth. And their one growth engine was taken away in Facebook. So Facebook's big blunder in all this is Zuckerberg should have been explaining to Congress and the media that while they were hated for their streams and news and data selling, they were so vital to small business in terms of customer acquisition that Apple has completely shut down this economy. And you have to know that Apple knew that. Meaning, let's go back to Apple now. Until Apple launches their own growth engine, their own ad network, where you can and let these companies back in, or launch their own competing way for DTC companies and small business to grow on their ad platform, small businesses decimated on the software side. And what Zuckerberg failed to do was explain that. What Toby at Shopify got caught without noticing, is how reliant he's been on Facebook and Snapchat for growth, all these small businesses. So Shopify. So basically, Apple is in a position to possibly buy Shopify right now let's look at Shopify, how far it's down. Someone's going to buy Shopify at a 70 to 90% discount to where it was just a year ago. So as bad as Shopify looks technically, I continue to own a little bit, because you're going to wake up one day and Apple or Amazon is going to bid 70 to 80 billion from this. Now, it could come from a 20 billion valuation, but Shopify is going to get bought. Okay, they have been shut off because of their reliance on Facebook and Snapchat for their small DTC companies. So they are in a heck of a lot of trouble in terms of growth. Snapchat is basically left for dead. And Apple comes out of this smelling like a rose, because they don't have a social network, so everybody loves them. And deep down, they're building their own social ad targeting platform on their own. So if we look at Apple stock, that's why relatively it has outperformed.
So you're saying Apple is the only winner here? Everyone else?
Well, it's been the only winner. And until Apple eases the foot on the throat of Facebook, or launches their own way for small businesses to grow in a digital way, the economy below them is going to suffer. And really, they're a consumer company. So as long as people can buy phones and watches and subscribe, but like Shopify and Facebook really screwed up by not explaining how evil Apple is and how really important those products were for small business growth, at least digitally. So that is a huge problem. We've sacrificed what we think are the companies we hate, or these big tech companies, for the sake of Apple. And Warren Buffett is laughing all the way to the bank. So kudos to people that own Apple, but at some point this will also drag down the economy, which it is, and hurt Apple too. And Apple's trading, I think, back below Microsoft's below. Is Apple not back below the 200-day moving average? Yeah. So anyways, you got to be defense. If I could share my screen, Ivan, with 3 more charts in it, and then I'll let you finish up here.
I'll stop sharing and then you share.
Yeah. I'm going to share my screen. Can you see it?
Yeah.
All right, so let me look at, do you see this first chart here?
Yeah.
All right, so let's take a look at the S&P 500 is closed below its 200-day moving average for more than 100 trading days. This is a long, and Joe's a great trader. That is 100, the longest streak since 2008. So if we go back to 2008 here, I'm circling it. Do you see it on the chart?
Yeah.
We can see how painful it got below the two. Bad things happen when you're below the 200 days. We can see back in here in an '08, and when it broke here, beginning of 2022, and then we tested it and it's crashed again here. So bad things happen. Obviously, bottoms form when we're below the 200-day. That's just history, right? Like stocks will bottom one day and they will be below the 200-day. But like you are in so much danger here. Plus, the damage isn't so bad. Like, if you're along the S&P, you're only down 17% from the highs. If you're just in an index, that's not the end of the world yet. So a lot of damage could still be out there in this next phase of the bear market in terms of index damage, and that's very much hidden in Apple. It's hidden in Microsoft. It's hidden in who else? Maybe I don't know who else the top five.
Tesla or something like this. Yeah.
Yeah. So it's really hiding there in plain sight.
Mm-hmm.
And so there is a little bit, and I've said this before, the best thing that can happen to this market potentially is a wipeout in Apple. 20, because now it's so on an island that you would, if Apple warns and is down 20%, we can finally we can finally look to other stocks and see if there's some relative strength, right? So until we find out what happens in this world when Apple pre-announces or Apple misses, we don't really know what to do in tech. So I really feel this is an important chart. The next, and so you've got to be defensive when you see this. You want to chime in on this one quickly, Ivan?
Yeah, I mean, basically the definition of a bear market is how long you spend under the 200-day moving average. That's my definition.
Okay.
And once you spend more than 3 months, you are in a real bear market.
Yeah.
And this is when you have to, be a little bit more protective of your capital. Yeah.
Especially because you get tired and you just start holding things, and it's okay to hold some things as long as you're not buying the dips on them. So Shopify, the pain is real. The mistakes have been made. Shopify is not going away, but even they don't understand. Like if you're internally at Shopify, they're trying to plug holes and figure out how to get growth going, but they don't understand where the real problem lies. And I think that lies within SMBs. Right? You have all these people that set up Shopify stores that can't grow because they're 2-person teams and they haven't even figured it out. And believe me, I've talked to enough small, and I've invested personally in enough small brands and hearing from the founders to tell me what the real problem is. So this is a big failure of Facebook and Shopify and even Snap, CEOs not explaining to the politicians or not lobbying the right people to explain the damage that Apple is inflicting. But yes, Ivan, what you said, 100 days below is 3 months. Yeah. You need to be extra careful right here. And then that's why I bring up the dollar and rates. Like if the Fed has no interest in reversing course right now. So where are you going to bet on? Okay, next chart. Can you see this one?
Yeah.
All right, so this is a really good chart from Murphy Charts. Discretionary will outperform staples with the strong equity bull market. Okay, so you can see in 2008 and 2020 the real panic. Okay, so at least we've taken out a lot of the excess. Right, you can see here we've taken out a lot of this excess, and these are better charts to look at, to be honest, when things are screamingly, a lot more signal was right here back in mid 2021 to maybe take some money off your risk curve here. Here we're in no man's land, but any big spike down would be a bet. I feel we're in no man's land from this chart, and then you combine it with the 200-day problem. So I think defensive is still where money is getting put to work. So that's not a growth market. Any comment here on this one, Ivan?
I mean, I would say that it's not just about defensive versus discretionary, but it's about low volatility versus high volatility. It's normal during correction, high volatility to drop, high volatility stock to drop much more, and that's why that graph looks like this. And it's normal also during uptrends, high volatility stocks to go up much more than consumer staples, which have a bet of, you know, close to 1 or under 1. So
yeah.
This is just normal, just saying that basically the water is wet. This is what happens in cycles.
Right. You don't love this chart. What I see here is defense is where money is getting spent. And then finally, before I just let you finish up here, I think this has been a really important thing that as someone who's never followed the credit markets or the spreads, and I'm learning that this is a really important tell. So widening credit spreads, which we saw in 2000, 2008, and luckily for 10 years, very few events of widening credit spreads, and probably that was Fed induced. You know, you have these screaming bull markets, and you can see here in the last year, we have continued to face a period of widening credit spreads. And, you know, it's not something you should watch daily, but you know, you have to be in a mode of defense. I think this chart really tells you that, you know, when we were long in tooth in this bull market, and this spike up here when there was no spread in credits was probably a good time to take some risk off. So right here, I feel like, you know, with rates rising and credit spreads rising and chunk bonds accelerating weakness, you have to just be careful. Doesn't mean I recommend people getting short. I just say, you know, wait for, and you and I talked about this, you know, it'll solve it when we see prices starting to break out, when we're a long way from that. But for any inkling of when to put on a next wave of capital, I would love to see more crash-like panic. And we're not even close to that. You know, in 2020, it was, you know, it felt like the world was going to end based on, you know, the VIX being 70 and 80. Right now, with the VIX in the mid 20s, it's elevated. Don't get me wrong. It's, you know, in a normal market, this would be fun to be, but we have been persistently in the 20s now and 30s for months. And so now we're in the low end of that range, and it just feels like there needs to be more panic based on the macro. And any thoughts on this one before we
I agree. I mean, the best thing that can happen to the market right now, to the stock market and to the real estate market, is basically having another 20% drop. I'm not calling for it, but I'm saying that something like this would basically reset valuations, and that maybe higher interest rates wouldn't matter at that point when valuation.
They wouldn't, because there is some point where the Fed is, they can't afford to have rates this high. We'll go broke, like everybody will go broke around us. So the game is in danger zone. The other side of this bear market will be good. But I think the last real big problem that needs to be solved right here, at least for the tech market, is Apple is eating people's lunch under the auspices that the consumer. Let me unshare my screen. Hang on, buddy.
Yeah, you're not sharing anymore. Let me share mine. All right.
So I think my biggest concern here, Ivan, is Apple, right? Like they're the last shoe to fall. It is the best company.
They are the market right now.
Yeah, they are the market, and they're masking an incredible amount. And listen, I hope I'm wrong, and Apple goes to all-time highs and the rest of the market goes with it, and there's lollipops and balloons for everyone, but there is so much trouble hiding in this Apple stock price for somebody. And I think we won't know more until Apple trades at 100 or below. And I'm not hoping for it. I'm just saying we can't know more, because right now Apple's destroying the will of startups. What's that?
100 is the 50-month moving average, which has acted as support over the past couple of decades, basically.
I don't see how we're in a vicious technology bear market, and this stock is still 35% away from its long-term moving average.
Only 15% down from its 52-week high. So
Apple has, like I said, Tim Cook, what he's been genius in is two things: not competing against Tesla. I really think Tesla was crazy in buying Twitter versus trying to take a shot at Apple. But you know, Elon Musk is Elon Musk. But Apple's second genius was not buying a social network. So good on them. But at the same time, you know, it's not helping at this point that Apple's eating everybody's lunch. From a consumer, I love it standpoint, but from someone who invests in tech, it's like I don't know how you compete. We're all beholden to the App Store and what Apple does. So those are my macro-ish shots. I hate being macro, but there's no point in picking stocks right now when the odds of being right is just too hard.
Yeah, especially if you have a longer term horizon, if your position, your swing trader it is definitely difficult. You have to, if you want to be active, you need to be really nimble in this tape and basically take some really short-term scalps, basically.
And you're telling me that you're leaning short side when you scalp right now.
Yeah.
Yeah.
Both sides, but mostly shorts in the past week. So yeah. I mean,
all right. Well, sorry for boring everybody, but I wanted to get some of these thoughts off my chest. And do you understand what I'm saying? Does that need to make sense?
Yeah.
Ivan, as someone who doesn't care about the stuff that I think about, does this even make sense to you? What I'm saying?
Oh yeah, absolutely makes sense. The question is how much of it is already priced in, and probably not everything, but probably a lot.
Yeah, I mean, I feel like you look at Shopify and you look at Zoom. They're not cheap, but they're amazing companies and amazing products, and they're trying to stop going down. They're trying to, but they look like they're ready to implode again, right? And that scares me.
Yeah.
And that's more about Microsoft and Apple.
That level, I don't know, probably could be a 40-50% drop.
Yeah.
Yeah.
And management they have no say in this, right? No matter what they do, it feels like they're in Apple's hand.
Maybe they need an Indian CEO, Howard, since every big company is getting an Indian.
Oh, they'll get one. No, Toby has ultimate power. So again, these are really, you're talking about one of the best companies in software and useful products to the American economy or new economy, going back and trading down to 2017, 2018 prices. And it just feels like we're right there, like we're on the verge of that happening. And maybe that's what needs to happen, but you won't get the return to growth until Apple's power over the consumer changes. So it's really a big macro chess game going on right now. And that's why I'm focused on that. So I apologize, everybody, but hopefully that helps clarify why I'm at best, 50% long hair, but really it's stinky out there and it feels terrible. So be really careful, I think, right here.
Yeah. All right, then. See you next week then.
See you guys.
All right, bye.